Hello and welcome to the Scan the Markets webinar with myself, David Madden. I work as a market analyst for Equity Capital in London, and Equity Capital is one of the many companies that is a part of the overall equity group, including FXpesa in Kenya and also Equity Nigeria in Nigeria. And for those of you who've not attended one of my Scan the Markets webinars before, what I'll essentially do is I'll run through about 4 or 5 of the more popular markets, talk about what's going on from a fundamental analysis point of view, what are the major stories in the news, and I'll also look at those markets from a technical analysis basis, which is essentially the study of charts. If anybody has any questions for me about the topic I'm currently discussing, feel free to say, "Oh, David, I didn't understand that. Would you mind going over it again?" or whatever it is. Feel free to ask away. And if you have any markets, any questions other than the one I'm talking about then and there at the moment, please leave those till the end. And if there are any markets that I haven't covered by the end of my run through, feel free to say, "Oh, would you mind taking a look at silver," or whatever it is, or dollar CAD, or whatever it is. I'll have a look at other markets. This webinar is purely my own thoughts, views, and opinions. It should not be taken as a explicit investment or trading advice. So the first currency pair, the first market we're going to look at now is euro dollar. So the currency pair has seen a lot of volatility in the past 24 hours, but also in the past few weeks as well. So what's been going on with euro dollar in the past 12-24 hours? Well, yesterday evening it came under major selling pressure. Why was this? Well, we actually had a interest rate decision in the US last night. The Federal Reserve, the US Central Bank, hiked interest rates by 75 basis points, and it was a larger hike than expected. Economists were predicting a hike of 50 basis points, although 75 was talked about a fair bit. With the fact that the bank took a larger hike than economists were expecting, they put upward pressure on the euro and downward pressure on euro. It drove up the US dollar and in turn drove down euro dollar. So we can see the currency pair come under a fair bit of selling pressure today. And what we saw was a turnaround in the currency pair today for a couple of reasons. Last night, although the Federal Reserve hiked interest rates by 75 basis points, they also said the possibility of a recession in the US has increased slightly. It wasn't a full-on recession warning, but they were just being honest, saying that the US economy is cooling, the post-pandemic boom is over, inflation is running really high. That's going to eat away at demand. Eventually, it is eating away at demand. It's going to be a continual problem for levels of demand. And today, the US Philly Fed manufacturing index, which came out around lunchtime today in the lunchtime, well, 1:30 in London time, 1:30 Nigeria, 3:30 in Kenya. That manufacturing report dropped to its lowest level in almost 2 years. So between last night's comment about, oh, the likelihood of recession has increased ever so slightly, with today's very disappointing manufacturing reading, that really got traders thinking to themselves, right, we could be in for a recession in the US. So with that, we saw the US dollar give up a lot of the gains that it made last night. So in turn, we saw a sharp turnaround in euro dollar. What's also been going on with euro dollar is we've heard from the we've heard this week, we've heard recently from last week rather, from the European Central Bank, that they're basically made it quite clear that they're going to hike interest rates by 25 basis points in July. Who knows? They might do a 50 basis point hike in September, but that's what basically is kind of on the agenda. So it's possibly to do with the fact that it's mostly to do with the fact that recession fears in the US have been the big theme of the markets in the last 5 or 6 hours. Although the US Central Bank is hiking rates, and they'll probably hike again next month, the fears of a recession are creeping higher and higher in the US. So taking a look at the price action here of euro dollar, in the very short term, we can't really ignore the fact that this is quite a bullish upward move here. And if you look at the MACD indicator, this histogram here, we can see that there's a steady increase, that momentum is in positive territory, and there's a steady increase in positive momentum. So that suggests that the bulls are in control. The RSI is moving higher as well, indicating the price bias is to the upside. So while euro dollar continues to hold above these two simple moving averages, just to let you know, by the way, I'm looking at a 4-hour chart. Most of the charts I've been looking at are 4-hour time frames, and the moving averages that I'm looking at are the 20-period moving average, the 50-period moving average, and the 100-period moving average. So while euro dollar continues to hold above these two simple moving averages, it's like the very kind of short-term upward trend will continue. A rally from here could encounter resistance from this simple moving average here, which comes into play at 1.0640, and a break above that could target this peak here around 1.0773. Now, even though the currency pair has been moving higher in the short term, we can't really ignore the fact that the more medium and longer term trend is clearly lower. Keep in mind, the lows that we saw yesterday or yesterday evening or this morning were back down to levels last seen basically 1 month ago. So it wasn't that long ago. Euro dollar was at a 1 month low, and the kind of more obvious price action of the past week or 10 days has been to the downside. So if we do see this short-term rally run out of steam and the market turns lower again and starts to roll over, where could we go from here? Well, we could, first and foremost, I look down towards this area here, almost at the base of this rally here, and at 1.0427. If you drop below yesterday's low, this morning's low, we could then be looking at targeting this zone here, the lows of mid-May, in at 1.0348. I mentioned about recession fears in the US, and this is precisely what we've seen. A very aggressive move to the downside in stock markets this week. So at the beginning of the week, there was growing speculation that the Federal Reserve were going to have a larger than expected interest rate hike, which put downward pressure on US stocks on the run up to the last night's rate decision. Although there was a bit of a brief kind of relief rally, as we now know, in the US last night when they did in fact hike interest rates by 75 basis points. Today, the Fed's comment and language regarding that a recession, the possibility of recession is now more likely, combined with the fact we had very, very disappointing Philly Fed manufacturing numbers, that really can add away to the argument, perhaps the US could be in for a recession. So we saw a sharp move to the downside, excuse me, in the US 500. We've now basically fallen back to a level last seen since around, basically by the looks of it, March 2021. January 2021. So it looks as if we've fallen to new 18-month lows. So the fact that we've dropped to a new 18-month low on the US 500 really kind of speaks to how bearish the market is. It's also worth pointing out, although the price that we're at now isn't too far away from the lows of the session. Looking at the MACD indicator, there's been a steady decline in positive momentum. The RSI is moving lower. In fact, it's now already moved into oversold territory, which in itself could be an early warning sign that the downward move in price has become overstretched. So if we continue to hold below these three simple moving averages, it's likely the medium-term bearish trend will continue. Moving lower from here, where can we look to target? Well, I'm looking back down towards, because we're currently around 36.79. If you continue to move lower, I'll be looking down toward 36.00, and then this peak here in around 35.88. Now, if we do manage to get a bit of a snapback, where can we go? Because keep in mind, the RSI here, the Relative Strength Index, that's moved into oversold territory. So that could be an early warning sign that, we've the selling pressure has become overheated, and that could be an early warning sign that a snapback in price is on the agenda. Should that be the case, where could we target? Well, I'll be looking up towards this simple moving average here, the 20-period moving average. If you follow it around, you can see on a few occasions it acts as out of support and or resistance on a few occasions. And what I often say is, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, but there are no guarantees. And you can see that this general zone, to be fair, I can clearly see that there are a couple of occasions the market managed to ever so slightly get above the 20-period moving average, but that as a general zone has acted as resistance recently. So there's a possibility it might act as resistance again. So if we do rally from here, resistance might be encountered from that moving average, which comes into play in around 37.82. And a break beyond that could see a target this peak here, the highs of the past, say, 24 hours, sorry, the highs of the last 24 hours, which comes into play in at 38.41. What's going on with the UK market, the UK 100, the FTSE 100? Well, similar situation. Essentially, fears of a recession, and the recession isn't just confined to the fears of a recession are not just confined to the United States. We've also had growth figures from the UK in the last, in the monthly GDP figures for the UK for recent months has been negative, have been weak, suggesting the UK could be in for a period of lower growth or even possible negative growth, hence why recession fears. Today we heard from the Bank of England and the caution about persistently high on inflation in the near term. That's a chipping that will chip away at consumer spending, and in turn, that's the sort of thing which will actually end up weighing on growth. So we can see here that a similar situation. We've had an aggressive move lower on the UK 100, the FTSE 100. A flip back to the US 500 chart here. An aggressive move lower on the US 500, an aggressive move lower on the UK 100. So this kind of ties in with what's an element of Dow theory. One of the tenets of Dow theory is that the averages must confirm each other, which essentially states markets that are quite similar, in theory, should be moving in the same direction at the same time. We've seen an aggressive move lower in the UK 100. We've seen an aggressive move lower in the US 500. Now, the UK 100 is in better shape because although it's moving lower, it's only at a 3-month low or a 3.5-month low. Whereas as we saw a moment ago, the S&P 500 is at a new 18-month low. So although things are bad in the UK, stock market wise, they're a lot worse over in the US. So if you take a look at the price action on the UK 100, moving aggressively lower, hit a new 3.5-month low, which is a sign of how bad sentiment is. We can see that on the MACD indicator, that momentum has swung from positive territory here into negative territory here, indicating the bears are in control. There's a sharp move lower in RSI, rather strength index. So we're actually essentially at, not quite, we're essentially at or just about inside oversold territory. So that in itself could be warning that the recent downward move in price has become overstretched. If you continue to hold below these 3 simple moving averages, it's likely the medium-term bearish trend will continue. And if you do go lower from here, I'll be looking down towards the lows of kind of late February, early March, around the time Russia invaded Ukraine. So I'll be looking down towards 68.42, and a break below that could see us down towards 67.61. These areas I'll be looking out for. I mentioned a minute ago that the RSI is essentially at or in oversold territory, so that could be a kind of a flash warning to say, the bears are kind of overstretched the market. Perhaps it could be seeing a bit of a snapback, and if you do, where could we go to? Well, we could retest this area here around 72.67, and the big one to watch out for will be this peak here, the high of the past 24 hours in at 73.30. On the flip side, I talked about how there's been a lot of concerns about recession in the UK, concerns about recession in the US. In fact, concerns the global economy is slowing down. In the last few weeks and months, we've heard from the likes of the IMF and the World Bank, and they've either expressed concern or they've outright cut global growth forecasts. And with that, people we're seeing selling pressure on stock markets. And one of the common traits of the financial markets is that money moves from one asset class to another. So stocks are considered to be higher risk assets, and assets that are considered to be low risks are things like gold and the Japanese yen and the Swiss franc. And we're now coming on to the gold market. So it's no real coincidence that the FTSE 100 fell to a 3.5-month low. The S&P 500 has fallen to a new 18-month low, and we're now seeing a multi-week high being posted, we're now seeing a multi-session high being posted in gold. So what we can see here in relation to gold, in the last few sessions has been moving higher. We've moved back above all 3 simple moving averages. We're back up to last two levels seen several days ago. Today's the 13th. Yeah, we're back up to kind of a multi-day high. Although gold that in itself hasn't taken off the highs of June, it certainly is moving higher. looking at the RSI, that's moving higher, indicating the price bias is to the upside. There's a steady, momentum is firmly in positive territory, suggesting the bulls are in control. So the gold market's moving higher. If we continue to hold above all three simple moving averages, it's likely the short-term upward trend will continue. Our further rally from here could see it up towards 1857, 1860. Beyond that, up towards 1866. And the real big level to watch out for gold will be the recent peak, the peak of June at 1878. Now, you can see here that the gold market has sort of been, oh, wrong one. The gold market, to a certain extent, has been sort of in a range, kind of a range, the last few weeks and months. So kind of put it loosely here. If we look at the price action, once we kind of got over this this bout of selling here in the middle of May, it never really kind of took these peaks here didn't even retest this high. When we sold off aggressively, we just about took out this low here. We didn't even get as low as testing the lows of May. So we're sort of trading in a range. We're sort of currently in the middle of that range. It could easily be a game of range trading for all we know when it comes to gold, whereby the metal will potentially drift higher. It might get up to around 1860, 1875, thereabouts, run out of steam, move a bit lower. If it drops down towards kind of 1815, 1807, potentially you could see a bit of a turnaround. That's what I'm seeing the last few weeks, the last month. We do appear to be in a range bound situation for gold. But at the same time, although we're currently in the middle of the range, and the past couple of days, we've seen the market moving higher. Why is this? Well, fears of a recession in the US. I mentioned a few minutes ago how although we have had a strong US dollar this time yesterday, almost this time yesterday, the US dollar was quite strong because the Fed were about to hike interest rates by 75 basis points. Today, because of looming recession fears in the US, has weakened the US dollar. Gold, like other major commodities, is traded in dollars. So the dollar is weak, that typically pushes up gold. Conversely, whenever the dollar is strong, that usually puts pressure on gold. What's also going on, as I've written here, is the risk-off attitude. Gold is an asset that typically benefits from a risk-off mood, or people willing to divert their funds into assets that are considered to be lower risk. So it's no coincidence gold's doing well today when stock markets are performing poorly, and vice versa. If you see stock markets roaring, that can often be a sign that you can typically see gold decline. If we do see a change around in the price action of gold, where could we go? Well, I've been looking down towards the recent lows, 1825, and then particularly the lows here of mid-June in around 1804, and the big level to watch out for will of course be the lows of mid-ish May, in around 1786. So what I really must stress is that financial markets are very much interlinked. I'll come on to this point again when I look at sterling yen. But for those of you who are out there who trade gold on a regular basis, whether you mostly trade gold or exclusively trade gold, you have to be keeping an eye out for what's going on with the US dollar. I can't stress this enough. The US dollar has a major influence on what's going on with gold, but what also has a major influence what's going on with gold is the overall risk-off, risk-on sentiment. Risk-off sentiment is typically when people want to have less risk. So they're dumping industrial metals like copper and platinum. They're dumping oils and they're dumping stocks. Because if you're optimistic for the health of the global economy, you would imagine you would need more oil and metals to fuel economic growth. If companies are doing well, their share price typically rises, so stocks rise. So when you're optimistic, typically speaking, stocks, industrial metals, copper, platinum, palladium, iron ore, whatnot, energies, gasoline, oil, they tend to rise. When people are fearful about the health of the global economy and think that the global economy is slowing down, and therefore economies will require less fuel, be it minerals or be it commodity energies, and also that's when those commodities fall. And also, if you believe the demand's going to taper off, companies, be it airlines or be it retailers or be it food chain, restaurant chains, or whatever, you'd imagine they're going to make less money, so stocks fall. So if you regularly trade gold, please, you need to keep an eye on what's going on with stocks and particularly stock markets, and also the US dollar. And then conversely, just look at the overall picture of what's going on with the mood in the markets. Coming on to the last chart of the day that I'll be talking about is GBPJPY, sterling yen. So I mentioned a minute ago about how gold typically performs well when stock markets are falling, and it typically is either muted or else actually actively falls whenever stock markets are booming. So we can see here the really big picture trend for sterling yen is higher. In fact, the highs that we saw here in May were actually multi-year highs. I think it's about the highest level in about 6 or 7 or 8 years. So broadly speaking, we have seen weakness in the Japanese yen across the board, which brought us up until early June. But since then, we've seen a sharp move lower for two reasons: fears about a recession in the UK, and then on top of that, an overall risk-off mood. You know, we talked about a minute ago about how we've had seen major declines in stock markets. So I know right now sterling yen is off its recent lows, but the lows that were set here in the last 6 or 8 hours sort of coincide with the overall fact that stock markets are under major pressure, and there are concerns about a recession in the UK, a recession in the US, in fact, a slowdown in China, in fact, a slowdown in global growth across the board. So for anyone who trades for sterling yen or dollar yen or any Aussie yen, any Japanese yen cross, any currency pair with a Japanese yen in it, you really, really need to be paying attention to what's going on with global stock markets. Not that you need to necessarily be trading them, but need to be looking at, ask yourself each day, are stock markets going higher? Are they going lower? What is the overall theme with stock markets? Because that can be a fairly big influence of what goes on with the Japanese yen. What's also worth looking at is we have seen a rebound of the pound. You know, part of the reason why sterling fell initially this morning, but then rebounded, was the Bank of England hiked interest rates today. They hiked interest rates by 25 basis points, as expected. But in advance of the meeting, there was a lot of chatter that the Bank of England might actually hike interest rates by 50 basis points, like how last night, how the Federal Reserve did a larger than expected rate hike. And there was some speculation that, maybe the Bank of England today will follow the Fed last night and do a larger than expected rate hike. Now, they didn't end up doing that. So in turn, when people saw, you're only doing a hike of 50, that actually put downward pressure on the British pound. Hence why we saw this move lower. But then as the day went on, the dust kind of settled, and possibly people went, right, possibly we might have been a bit too long the pound in advance of the meeting, and we kind of had quite high hopes for a 50 basis point rise. And also, when all the dust settled, it transpired that of the 9 members of the Bank of England, 3 members actually voted for a 50 basis point hike. So you'd imagine into the next meeting that we're going, the Bank of England, we'll probably have we'll probably have at least another 3 members that want to do a 50 basis point hike. So if they get a couple more on side, because the way things are going, inflation in the UK probably isn't going to be coming down anytime soon. So we could be looking at more rate hikes from the Bank of England. Who knows? Maybe the next rate hike for the Bank of England might be a 50 basis point hike, and that's why we have seen a bit of a turnaround in GBP USD. So in the more kind of medium term, both the short and the medium term trend for sterling yen is lower. And let's face it, while the currency pair continues to hold below these two simple moving averages, it's likely the more medium term bearish trend will continue. Further declines from here could see it retest the lows of today, just below 160 and at 159.98, and a break below that could see us back down towards 159. And if you go below 159, I've been looking down toward these lows here in around south of 158, in around kind of 150, 157.80. But at the same time, we can't really ignore the fact, and now zoom out to a daily chart, we can't really ignore the fact that we've been in a colossal upward trend on sterling yen. In fact, the highs that we saw earlier this month were back up to levels last seen in 2015. So not that long ago, only a few weeks ago, sterling yen was up to its highest level in about 7 years. So the really big picture for sterling yen is higher. It depends what goes on with stock markets. If people start thinking, if renewed conversation builds up that the next Bank of England interest rate decision will be a hike of 50 basis points, that could help sterling. If stock markets turn around and start moving higher again, that could diminish demand for the Japanese yen, and therefore the yen falls, and that could also help sterling yen. On the downside, recession fears are pretty high. You know, I saw the Dow Jones over in the US down over 700 points at one point. You know, we saw massive losses. The S&P 500 was down almost 3%. I saw last. Sentiment isn't great at the moment, particularly in stock markets. And while sentiment remains weak in stock markets, there'll probably be a certain level of demand for the Japanese yen. I have a question here. Give us a correlation of currencies and commodities. Also, kindly give us GBP will be affected by today's news and release. As I just mentioned that a minute ago. I just commented on sterling a second ago. Like I said, going into the meeting, it seems to me traders were kind of getting ahead of themselves and thinking, right, we'll start buying the pound in advance of the meeting, because even though economists are predicting a 25 basis point hike, they'll probably hike by 50 basis points. So traders were overly long sterling, thinking that there's going to be a 50 basis point hike, but there wasn't. It was only 25 basis points. So in turn, that actually led to a short-term sell-off in the pound. But then people realized, okay, they didn't deliver the 50 basis point hike that we're kind of making educated guesses that they would. But of the 9 members of the Bank of England, 3 voted in favor of hiking by 50 basis points. Chances are those 3 would probably be in favor of a 50 basis point hike at the next meeting. And also chances are, I don't see the inflation situation in the UK improving anytime soon. So who knows, there might, although there were not a majority of the 9 members voting for a 50 basis point hike today, there might be a majority in favor of hiking by 50 basis points at the next meeting. So with that in mind, we seem to have, at least in the short term, seem to have seen the bottom or the floor for the British pound. You know, although stock markets in the US are weak, they're off their recent lows, and when they're off their lows, we've also seen a bit of a pullback in the Japanese yen. In relation to commodity currencies, sure, I'll happily talk about commodity currencies. You just basically have to know the basic outline would be, if you look industrial metals such as copper, platinum, palladium, the likes, iron ore, stuff like that, zinc, particularly copper. If those industrial metals are strong, that typically boosts the Australian dollar, because Australia has a relatively large mining sector as a component of its overall economy. So if you see industrial metals strong, that usually pushes up demand for the Australian dollar. Conversely, if you see a decline in industrial metals, that typically puts downward pressure on the Australian dollar. Also, what people will be doing is people will be looking at who's buying these industrial metals. China is one of either the second biggest or the biggest importer of minerals in the entire world. So people view economic announcements from China, be it manufacturing numbers or services or unemployment or retail sales or whatever it is, or fixed asset investment or GDP, all through the prism of will these numbers speak to a healthy Chinese economy? And a healthy Chinese economy typically requires a large amount of industrial metals and also oils, but industrial metals. So when people start seeing strong economic indicators coming out of China, you typically see metals rise, because the assumption is China will want more minerals, and the assumption is also the Australian dollar will increase. So you typically see kind of go one from the other. Things are improving globally, things are improving in relation to China. That usually drags up metals and also the Aussie dollar. Also, I mentioned oil a second ago. Canada has a relatively large oil and gas sector as a part of its overall economy. So everything I just said about metals and the Australian dollar apply the same logic, but to oil and the Canadian dollar. So whenever the oil market is fairly strong, that typically and oil currently is strong, that typically pushes up demand for the Canadian dollar. And then conversely, whenever you see weakness in the oil market, that usually puts downward pressure on the Canadian dollar. So if you are trading the Australian dollar against any currency pair, be it the Japanese yen or the British pound or the euro or the sterling or whatever it is, if you're trading any currency pair that has the Australian dollar in it, you should be looking at what's going on with metals. Go on our platform, what's going on with platinum, what's going on with palladium, what's going on with copper, to a certain extent, what's going on with silver, what's the broad feeling within the industrial metal sector and try to figure out from that angle. At the same time, you can't just be focusing purely on Australian economic indicators and even to an extent Chinese economic indicators. Same with oil. If you trade oil if you trade the Canadian dollar CAD or whatever it is, if you trade any currency pair that has the Canadian dollar in it, the CAD, you need to be paying attention to what's going on with oil. Ask yourself the question: is oil in an uptrend? Is it down in a downtrend? What's the forecast? And what's the kind of overall sentiment surrounding oil? So these are the kind of typical the connection and the correlation between commodities and certain currencies. Are there any other questions? I'm conscious of the fact that I've been going for just over half an hour now. Any other questions about the markets, or are there any markets that I haven't covered that you want me to take a quick look at? No questions so far, so I'll be wrapping up things in a second. For those of you who are on Twitter, feel free to contact me on Twitter. My handle is @dmadden_equity, @DMADDEN _EQUITI. Feel free to follow me on Twitter. Feel free to tweet at me and ask me a question saying like, oh, what do you make of the British pound, or what do you make of pound dollar or whatever it is, or gold, or whatever market you want me to take a look at. Obviously, I can't give you any advice. What I can do is I can provide commentary similar to what I just laid out in today's webinar and talk about the prevailing trend. If the prevailing trend continues, we could target the prices A and B, or if the market were to turn around, we could target the prices X and Y. So feel free to contact me via Twitter if you have any questions about the markets. And seeing as there are still no more questions, I'll look to wrap things up there. I'll just give it a few seconds in case there are any late entrants question-wise. There's nothing going on in terms of questions, so I'll look to wrap things up there. For those of you who watched the webinar live, I appreciate the effort, and I also appreciate the individual who asked a question about commodity currencies and also sterling. These webinars and YouTube lives are always much more interesting when I have a bit of interaction. Like I said, feel free to contact me on Twitter. Happy to have a chat with you via Twitter. I will be back again same time next week, so feel free to tune in then. So everyone, have a good week and talk to you soon.